that's worth owning now that the pandemic's starting to look a lot worse, maybe a lot worse outside of the New York metro area. I think some of the specialty real estate investment trusts still make a ton of sense. Companies like Alexandria Real Estate Equities, that's a longtime Kramer fave, that owns science and technology facilities, especially pharma and biotech labs. Most office REITs are totally toxic right now because for white-collar workers, the stay-at-home economy will be with us for a long time. But laboratories, research centers, we need more of these things if we're ever going to beat COVID. And it's not like you can conduct serious biomedical research out of your basement. We know Alexandria reported a very solid quarter a week ago, and the stock pays you a juicy 2.8% yield at these levels. I think it's a terrific place to hide if the averages keep getting slammed. Don't take it from me. Let's check in with Joel Marcus, the founder and executive chairman of Alexandria Real Estate Equities, to hear more about the quarter and his company's prospects. Mr. Marcus, welcome back to Mad Money.
It's a pleasure to be back with you, Jim, even in this very terrible time of COVID-19. My best regards to everyone who's been impacted personally, both health-wise and financially by this terrible pandemic.
You know, it isn't a day that goes by. I mean, when it started, you didn't know someone, and then you started knowing people, and then you knew people in your close circle, and now it's just every day. I mean, is it the same where you are?
It is indeed. California has been less impacted, but we took early action by social distancing and closing down, and I think that's paid off. And obviously, there's a lot more room here in California than there is in places like New York City and New Jersey, as you well know.
Oh, yeah. Now, Joel, when I go through all your documents and your Q&A and conference call, you're different from most REITs I deal with. You're directly involved as a partner. Most places, they just take the rent. Why is Alexandria far more in partnership, say, with Moderna than a lot of office REITs are with their tenants?
Well, thank you, Jim. For sure, Moderna is a very important client tenant of ours. We started with them back in 2015 when they were first founded by Flagship Laboratories. Our teams are 24/7. Delivering services, providing important jobs, and really providing frontline resources to the critical, innovative companies who are really on the front lines of the testing, of the therapeutic development, and hopefully solutions to the vaccine problems. And we operate 24/7, and our people really are essential, and the laboratories in which they work truly are essential.
So when you're working on these partnerships, it would seem that initially I was worried that people would be able to do the lab work and then leave your offices and go home because I'm worried about the stay-at-home thing. But that's just not economic. Your people need to be at your buildings.
Right. And the way they've worked out is those in biotech and pharma, those who can work from home in sales and marketing and other executive positions right now are doing that virtually. But many of the frontline researchers and in the manufacturing plants, very interestingly, we built Moderna's manufacturing plant in Massachusetts as well. They are taking shifts in the laboratories. Many of them are working 24/7, social distancing. Laboratories, by their very nature, pretty interesting, have built-in social distancing. We provide, and they get 24/7, 100% fresh air. And, wearing masks and gloves, that's done typically in the laboratory, full PPE. So they become almost naturally protective in that environment.
Now, recently you announced a very big acquisition in one part of California, and you walked away from a building that looked like an historic building, but I don't know, in San Francisco. Can you explain to me those moves so that I can understand in an environment where the rent, it's 2.2, there's no occupancy, there's nothing, you can't find any space. Why would you ever walk away from one and get big in another?
So that's a good question. So the couple of the acquisitions we did in San Diego really surround a important mega campus we're developing for both technology and life science companies. So that was an important add-on to that campus development. The property we walked away from, first time I think in the history of the company we've ever done it, it was a tech office building inside the city of San Francisco, where as COVID hit, we realized that the tenants themselves, they weren't laboratory tenants. Our goal was someday maybe to convert that to laboratory. The rents were under market, and we felt at the time our underwriting had to be reassessed, and it wasn't worth the value that we were thinking about. So for the very first time, we walked away.
Well, I mean, I want people to know that you have a total return of 1,450% since your IPO in 1997. So to me, if you walked away, it's because you made a judgment that you're not just going to stick by a deal if the deal's not economic.
That's correct. And if it was a full operating laboratory today with rents under market, and we knew that the rents that were established and the companies that were there were operating, then we probably would have proceeded, but those weren't the facts on the ground.
One last question. When we did our REIT analysis, and we included you in our anti-COVID $11 trillion worth of companies, it was very clear to me that if you weren't a REIT, you wouldn't be part of a cohort. I want REIT for tax purposes. But if you were just a growth stock, I think your stock would be higher because the REIT index is so heavily shorted. Do you ever find that to be the case?
Well, that's true. Many investors invest for us, obviously, for a total return. The dividend is very attractive. We also have a $1.1 billion venture portfolio that is marked to market. Our cost basis today, even in a bad market, is a little bit over $700 million, and we're up mark to market between $300 and $400 million to get to about a 1.1 carrying value. So a number of people invest in us for a variety of different reasons, but historically, it really is the great cash flow. As you know from our first quarter results, our earnings were up, or our revenues were up 22%. We've given guidance this year, reiterated guidance, only down 1%, really due to retail, and we'll continue to increase the dividend this year. So we feel very good about our position, and we collected 98.4% of our April rent, which JP Morgan said was #1 of all of the office and commercial REITs.
Right. Well, thank you so much, Joel Marcus, chairman of Alexandria Real Estate Equities, doing really the best among my REITs that I follow. Thank you so much, sir.
Thank you, Jim. Always a great pleasure to be with you.
Look, if you want a real estate investment trust, you have to have them. You have to have tenants who pay. You heard that, 98%. And I gave you that performance. Pretty amazing. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.